Now we're going to kick off with the international markets, and we want to look at what's happening with Saudi OSPs. For those that have been watching us, we've been saying that there was going to be a sizable cut for official selling prices, and we got them. We got them into Asia, into Europe, but it was interesting because one of the places that we thought we were going to get as well was into the U.S., just because the U.S. would love to be able to buy the heavier crudes, that would ease a lot of the problems. But you can see that there were cuts to Asia, cuts to the Med, cuts to Europe, but there was no cut to the U.S. And when you think about it from Asia's perspective, so the super light through light, you're competing against Urals. So medium to heavy cut is good. That should help alleviate some of the problems on the refining side, because there's been a huge amount of pressure on refined products just coming into Asia, just because we have a lot of issues coming down the pike, especially when you have the increase in the export quotas from China, which is going to impact the amount of product coming into the Asian theater, and we think that'll show up in both Singapore and Fujairah. So here, when we start looking at the different pieces, there's a lot of these other issues that remain, where you look at the Med, and they're trying to get more competitive into the Mediterranean, into Europe. But what is really happening, because you have Libya coming through at a sizable clip, you have CPC coming through, you have U.S. product coming up, and then you have the increases from the North Sea. So again, I don't see a huge amount of demand increasing into Europe. You could see that getting absorbed into the U.S., but that's where we see some of this conflict in terms of, well, how quickly will the glut clear if the U.S. isn't going to be a buyer, or you're continuing to price yourself out on the heavy and medium side. Now, just to put it into perspective, we wanted to look at the OSPs in regards to discounts in previous years. So this is the Middle East Arab light crude to Asia. You can see that it's still above average, but it's closer to normal. The problem is, but what is happening with Urals? Like, how are you competing against Urals, where you're cutting prices, but you still have Urals that are trading below $50. You have ESPO that's coming down at a steep discount. So why if I'm China, if I'm India, am I going to buy Saudi, or am I going to buy ESPO? Am I going to buy, steeper discounted West Africa, or am I going to buy Saudi Arab Light? And again, that's where we see a continuous problem when you look at some of the flows coming into the market. Middle East Arab heavy heading to Asia, you can see, is well below average, and this is pricing it to move a bit more, and it doesn't have as much competition in Asia. And then if you think about what the refiners need, they're going to need that heavier grade in order to produce the diesel and distillate that is so short, and that's where they have the most margin. And for every cut in OSP, it really does help the margin on the refining side. So this is a little bit of a reprieve, but as you have additional product coming out of China, we still see some headwinds for the refining side. This will help offset it. And I think what Saudi's hoping is that it'll keep them operating their runs at the same level instead of starting to reduce activity. Now, when you look at heavy crude going into Northwest Europe, you can see that it's below average, trying to price a bit more aggressively into the market, which is a positive. The question is going to be, does anybody in Europe want it? Because they do have access to growing grades, or at least elevated grades. And then you still have reduced runs. You have economic headwinds that continue to persist in Europe, which is going to be a problem for underlying activity. But then when you look at the U.S., and this is just looking at heavy, because again, the U.S. isn't looking to buy light at this point. If you look at heavy, you get an idea of just how insane that spread is between the two. And that's where, when you look at the different backdrops, you can see that there is there's no reason at this point for the U.S. to be going out there and buying additional flows. Now, when you look at total OPEC production, you can see that the December estimate was at 29.1, November output 28.9. So you had a small increase. A lot of that was just driven by West Africa. You had Nigeria increasing a small amount. You had Angola increasing by a small amount. But realistically, Angola decreasing by a small amount. But Nigeria was the one that really carried this. As we go into January, when you look at December estimates into January estimates, realistically, we should probably get to maybe 29,200. There shouldn't be too much of a pivot one way or the other because Libya is kind of here. We don't see that changing. When you look at Kuwait, same. Iraq, same. Saudi, something similar. It's really going to matter on what does West Africa do. That's going to be the swing. And based on production estimated loading schedules, we should see a little bit of an increase coming from Nigeria as well, which will support some additional flows. Saudi December exports were fairly stable versus where we were in September, October. Bit of a drop in November, but you saw again Japan was fairly flat. China was a bit lower. It was really India that made up the difference between November and December, with some other Asian nations taking some additional allotments. So again, we just see it's being fairly stable. Russia's struggling a bit. Here you can see that Russian seaborne crude shipments have fallen. The bigger issue that we see is right now they're pumping out as much diesel exports as possible, but again, exports should be fairly stable here. The question is going to be is as diesel exports become more difficult as we get closer to February and the issuance of the new restrictions, as Russia can't produce diesel to the same level, does that mean that they're going to have run cuts, which is going to then put more crude into the export market? So even as production comes down, you could actually see exports remaining a bit elevated, which is going to be an important one to watch. Now, 4-week average crude shipments from Russia by destination, as we've been saying, more and more of it is being slated as unknown. They're trying to be a bit cagey as to where it's going. At the same time, they may not actually have a buyer, but they know that the demand is going to be in Asia. So trying to preemptively get it there just because of the shipping times, the sailing times, making sure that it's there for when it is actually purchased. So now when we look at the Middle East, you can see that we closed out the year at the highest level of floating storage outside of 2016. That is, again, more of the impetus that we saw for Saudi specifically to cut OSPs. But just based on these levels, based on what they did going into based on what they did going into the U.S., based on the issues that we see going into Europe, we still see floating storage remaining elevated. So that might result in an additional OPEC cut. But again, we don't see too much of a change in the near term on the floating storage side. When you look at U.S. exports, we closed out the year at about just over 4 million on the 4-week rolling average. We still have a lot of flows going into both Asia as well as into Europe, and that's something that's going to remain the case just given some of the pricing metrics that we see of WTI versus Brent, WTI, LLS, MEH versus some of the other grades in the market, which is going to keep things rolling through. But at the same time, you're going to have a bit of refiners shifting to a heavier slate. So we could see Asian demand slow. Europe, we think, stays strong. Asia slow a bit. Some additional of that heavier crude from Saudi, which again will put us just say closer to about that 3.8 million barrel a day level. Then when you look at Dubai versus Brent, fairly stable. We don't see too much deviation here. It could move to 4. Again, it's just going to kind of stay within this steady state as we go through the beginning of Jan. Global crude on the water, we closed out the year on a high. That's something that's going to remain. A lot of that is driven just based on what's happening with Russia, the delays getting product off the water, just because we have the most product on the water ever. So there's the transit, there's into floating storage, and how quickly can you get those cargoes unloaded. transit. Some of it, this is what we were talking about, transitioning from transit to floating storage. So here you had that big spike in floating in transit. Then as that comes down, it should create more floating storage. So as we were saying, we expected to close the year near the highs. You can see where we were right around where we were in 2020 and 2016. And that's something that's going to persist as that crude in transit moves into the floating storage front. Asian floating storage here, you can see, as we were saying, we thought it was going to close right around where we were in 2021. And here we are right at these levels. That's something that we think is going to continue and really above where we were in 2020. Above where we were to start the year in 2022, but below where we were in 2021, just given kind of splitting that level. Just given there is demand, you are seeing that the increase in export quotas is very helpful when you look at some of those movements coming through. And that's something where that will help in general in terms of moving some of the product off the water. China crude super tankers, they were at the highs starting in October, which maintained through November and the beginning of December. But now things slowed down to kind of a steady state where right around where it was previously. We think it's going to stay right around there. And that's just a lot of these refiners are trying to take advantage of some of the pricing from Russia, some of the prices that they are available, as well as starting to increase some of those runs now that they have the export quotas. So we should see that remain fairly healthy. But it's important to appreciate that it takes about 3 months for crude on the water or crude in a tanker to turn into product. So October, if you think October, then you have November, December, January. So they were already importing extra crude for some of this run up. So you have to think about kind of where we are and if they're really going to have to come out and aggressively buy. And the answer is they're not going to aggressively buy anything. It's going to be fairly stable versus previous Januaries and not this huge run up that I think some of the market has been expecting. Shandong refinery utilization rate dipped a bit. We still think this is going to creep closer to 69%, and they're going to try to get there ahead of the Lunar New Year break. West Africa, again, closing out the year at an elevated level, obviously not where it was in 16 or 2021, and we expect it to remain at this steady state and start off the year right around where it closed. Crude exports in general from the U.S. were strong. Gasoline, distillate, again, a lot of this is just based on the pricing that is there, getting product out of PADD 3, trying to manage that storage. As we showed, gasoline is elevated there, a lot of different elevations. And then when you look at exports, closing out the year strong, same with propane, propylene. Again, a lot of that is just that demand remains abroad. Then when you look at flows, you can see here gasoline closed the year right at the highs, and we think it remains well above the 5-year average, just given where the market sits and just where storage is in PADD 3. Same can be said for distillate. We think it should set a new seasonally adjusted record, obviously well above the 5-year average, and likely setting a new seasonally adjusted record. Same with crude exports, going to stay strong. And then when you look at propane, propylene, there's still the demand abroad. We're still priced competitively, and we're not getting a lot of that flow from Saudi Arabia. So again, that's going to continue to support our exports. When you look at Fujairah had a small drop of 320,000 barrels after seeing a bit of an increase last week. It stayed above the 20 million barrel level. Light distillate fell 640,000 barrels to 6.8 million. The east of Suez gasoline complex strengthened during early trading as Chinese domestic demand rose with relaxed COVID restrictions. But COVID gasoline exports are expected to be limited in January because of the eased mobility. But when you look at it, you're starting to see some concern about the pace of domestic demand recovery. And that's what we've been saying, which is why we do think that there's going to be an increase in demand, but it'll be a bit diminished. And we should see more of that going into the export market instead of being consumed locally. Middle distillate rose 30,000 barrels. East of Suez gas oil market was supported in the near term from colder temperatures. So while the U.S. is warm, you're actually getting some cold in Asia, which will support some of that gas oil market. The Chinese government has issued around 151 million barrels of export quotas for clean products. 8 million tons or 50.8 million of fuel oil. So that is going to put a bit of pressure in Singapore, which we should see additional inventories in both Singapore as well as Fujairah, just because you kind of get that backwards of going east to west instead of that west to east. Heavy resid rose 290,000 barrels. Bunker demand at both bunker hubs started on a slow note. That's something that's fairly stable. And we see that that's something that's going to continue to be an overhang as we see that slowdown in underlying demand for shipping. But also there's a lot of heavy sulfur in the market, the heavy sulfur fuel oil coming from Russia and getting stuck with no real buyers, keeping the heavy side on the heavy distillate resid side quite elevated. Brent time spreads, we're still in contango. We don't see it getting much better. And if anything, we see it maybe getting a bit worse because there is an expectation that that March into April will be better. So we should get some of that short-term contango. When we look at flows, as we were saying, you have Nigeria, which is coming in a bit below where we were in December. That should put a little bit of an overhang on some of those production numbers, but Angola getting a bit better. So again, you're seeing some of this back and forth. So that's why when we say what is OPEC production going to look like, December into January, it's going to be kind of blah, just not too much one way or the other. Norway still at the highs. That's going to remain. Vital withdrew an offer for Nigerian brass. They've been cutting differentials. It started at $6.50. It declined to about $6 more than dated Brent. Congo differentials are gaining a bit of support. They're cutting runs a bit, cutting production, loadings a bit. So that's going to put a little bit of a bump in differentials there. Then when you look at cargoes cleared last month, January so far at $6.50 below dated Brent. So again, they're looking to drive that up a bit. So they're going to reduce loadings, see if they can get some better pricing. Average price for Urals for the year was, last month was $50.47. So again, still seeing that below those levels that were allotted. And again, there's a lot of ways to get around that. CPC observed flows. CPC blend rose last month to the most since February. It's still remaining fairly strong. Then when you look at Europe, Fortes weakened a bit. It was at $1.55. Now it's at 80 cents dated Brent. So you're seeing some of these kind of back and forth where West Africa getting a little bit better, Europe getting a little bit weaker. Vital offered Gabon's Rabi Light crude at a deeper discount in mid-December. So again, it went from $6 below dated Brent to $7.15 below dated Brent. And that's where you're getting some of these different grades trading at different levels, where some of West African grades are getting a bit better, some are getting a bit weaker. And that's why when we said differentials are kind of flattish, it's because you had a discount come through from Saudi that will increase and other people will follow suit, including the UAE, Kuwait, Libya actually increased their OSPs a bit. So that's where you're getting some of this balancing act, netting out to grade specific, not a huge discount, but that's why we think, realistically, the physical market is saying, the futures market, there shouldn't be too much of a change after it's priced in some additional slowdowns, which I think was that drop from 86 to 78. In Europe, we pretty much closed above average. We see additional builds coming into Europe. So we think 2023 is going to start off at a fairly elevated level. Then when you look at what happened here, gasoline storage built. That's a problem. Gasoil did increase as well. When you look at Gasoil, there's been a big rush to buy as much diesel from Russia as possible. So we should see some of those increase in the near term. Gasoline closed out the year at all-time highs. We think it's going to start the year at all-time highs. Again, slowdowns from just seasonal demand within Europe, as well as just that ARB still being a bit tight coming from Europe into the U.S. markets. Fuel oil closing out at a fairly elevated level. Again, there's really not much demand going into the West, which is the East, which is keeping some of that stuck in Europe. Now, this is a little bit harder to see, but we started out the year with a build of just over 2 million barrels. So you can see we're well above the average, and we're starting out at the higher end in terms of what's in storage. Now, when you factor in some of those additional exports from China, some of the additional movements limiting from the Middle East, additional flows coming in from Russia, that's obviously going to lead to some problems when you look at where storage levels are. And that's when you look at light distillate, you can see it's just below where we started 2019. But again, we expect this to stay either at or near the all-time highs on the light distillate front. And then when you look at middle disti, it got a little bit better. It's above where we started out, but we do see it remaining at the low end, getting a bit better just because you're going to have additional flows from China. You're going to have additional heavy crudes being run, which should increase this a bit, but again, keeping it well below average. And then resid started the year off at an elevated level and will stay higher and likely move up again as those additional Russian cargoes try to take market share, try to move product, which is going to leave more of this in storage. North Sea closing the year at a fairly average number. We think that's going to remain the case, especially as we have new capacity coming online, and just a matter of where some of those move. Differentials are coming down, which means that they're struggling to move some cargoes. So we could see floating storage remain a bit elevated, and Europe closing the year out a high. And that's something that's going to support that onshore to offshore component that we've talked about, leaving onshore storage elevated in Europe. So that's what we have for you today. If you have any questions, please feel free to reach out in the comments section, on Twitter, by email, because we always enjoy hearing from you. Thanks again for watching. I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network.